and good afternoon, everyone. It is July 30th, Thursday. Welcome to Morgan Stanley Asia Macro Webcast. My name is Crystal G, Asian EM Market Strategist. Today we have Chetan Iyer, Chief Asia Economist, Laura Wang, Chief China Equity Strategist, Jun Sak, South Korea Equity Strategist, and Head of Korea Financial Research, Sho Nakazawa, Japan Equity Strategist, Daniel Blake, Head of Asia's Market Strategy, and also Asia EM Equity Strategist. During this session, you can send us questions at any time from the Ask a Question text box. First up, we have June today with us, and then Kasi apparently has had a lot of volatility recently. Can you share the reasons behind the correction from the peak of like 9,000, and then whether it's mainly technical consolidation, given the negative headlines, or there is a shift in fundamentals? Over to you, June.
Yes, thank you much, Crystal. What a month it has been for the Korean market. As of yesterday, Kospi had given back more than, I think, 60% of the year-to-date gains. And, breaching of the 6,000 level of Kospi was a bit of a surprise. So while we did expect a choppier second half, compared to the first half, but the unwinding process was, I think, more severe than what was kind of expected because obviously we had a lot of ebbs and flows with the news flow about AI, and then we also had the uncertainty on the FOMC, rate path. The Middle East situation, continues to be kind of ongoing here. So all those headlines were not really that conducive, but really kind of drove the correction seems to have been the technical factors of the market. So we've been kind of flagging that the broadening out of kind of investor base and also leverage is going to be a double-edged sword, and it's kind of turned out that way. And if you look at how strong Samsung Electronics and Hynix were, a lot of the push up did come after the single stock leverage ETFs were actually launched. So in terms of a news flow, it's probably still going to be back and forth on the AI capex issue. But if you look at the single stock leverage ETF issue, it seems the unwind is actually kind of getting to the end part of it. So if you look at the AUM for the single stock ETFs, it peaked at 17 trillion, and now, and that's mid-June, I think. Now it's at around 9 trillion, and it's likely to probably get lower. If you look at the synthetic, there's the short gamma out there, the exposure to the two chip makers. I think at the peak it was actually above 500 million, but now it's gone down probably around 300 million level. So we are seeing that unwind happen. I think in terms of the leverage ETFs, they are toughening up the rules here, and the customer minimum deposits going to be raised from 10 million to 30 million as of tomorrow. There are going to be tougher trainings, no new listings, but they're also kind of talking about other changes, such as limiting the transaction size to 20% of their total financial investments for individual accounts, and maybe even considering a Hong Kong flexible leverage adjustment. So I think just overall, we are going to see less leverage in the system. Now, that includes like layer 1, layer 2, which would be the actual lending from the banks and the non-banks and the margin lending side. So this kind of points to that, liquidity is probably going to have to come from elsewhere. And we've been kind of flagging that the foreign side is where we need to see the flows kind of coming in. And so the positive angle on that is the rebalancing, kind of selling pressure seems to be alleviated. And from here, we just need to kind of follow how the story plays out for the market itself. And we've been calling the bottom for the past kind of 2 days, and our capitulation ratio is kind of hit, I think it was minus 2.53 yesterday, and that's kind of a non-crisis period low. So I think today we always saw the Samsung results come out was quite positive here. The reaction is not as it's a bit muted because, again, not really a surprise here, but it's, it has stopped the downward spiral. And we need to kind of continue to follow the AI story from here. And maybe time is needed, but our software analyst, Brian Novak, is expecting like a 15-25% ROIC in the mid to long term. But what's encouraging to us is that we're seeing a broadening out, and we've been getting a lot of questions about, AI agnostic sectors and defensive ones. And so, some of the ones that we're talking about a lot was kind of defense, energy security, financials, and the reform. So we are actually seeing a bit of a broadening out. And on the reform side, we do expect to see more actions and news flow. The Capital Markets Act, the Anti-Stock Suppression Act, maybe even changes to corporate pension. So there's a lot on the menu right now, and a lot could be coming out in the third quarter. So what we would say is that we use the saying from the Aesop's fable that slow and steady wins the race. So this broadening out may not be able to move the needle in the near term, but we do see a healthier kind of climb from here, which could be a more broad base. So I'll stop here.
Thanks so much, Jun. And next we have Chetan today with us on the line as well. Asia currently is at the intersection of AI, Fed policies, energy, and El Nino, and then the confluence of all of these macro factors. So Chetan, can you share what's your outlook for growth in Asia with all of these uncertainty in mind? You're on mute, Chetan.
Yeah, sorry. Good morning, everyone. So on today's webcast, what I wanted to share was essentially the risk factors which investors are raising with us as regards the Asia macro and growth outlooks. Let me list the measures that we've sort of heard from investors, but it's also what we see in live in terms of the events and developments that are raising this question. So are you able to see the slides, Crystal?
Yes, we can.
Okay. So essentially, I think the 5 risks that we are focused on are number 1, it's the AI capex. And then number 2 is higher oil prices, the risks of El Nino affecting agri production and food inflation, tariffs, and whether the central banks will have to hike faster than what we have in our base case. In terms of AI capex, which we think it's out of the 5 factors we discussed, it's the most important one. The concerns that investors are raising is the timing and the magnitude of returns that AI adopters will get, and therefore the rate of growth in their AI spending. The second one is related to the infrastructure bottlenecks on memory and power supply, and whether that will affect the pace of investments in AI. And finally, the third one is the margins of LLMs, and therefore whether they will be able to take up the capex in AI at that strong pace that we have seen recently. Our global thematics team and Brian Nowak's, who's covering the tech space for us in terms of hyperscalers, they've both put out research pieces, which are explaining and sharing our house view on as to why we still think that AI capex is going to continue. But in any case, from macro perspective, what we are seeing in Asia is that even if there is some slowdown in AI capex, as long as it's not contracting, but the pace of investment slows from the very strong growth rates that we have seen until recently. For Asia, this is still not taking away our constructive view on Asia's growth story. First reason to understand there is that Asia's overall capex story that we have been talking about is based on multiple drivers, not just AI. It's to list again, it's energy, it's defense, and most importantly, broader industrial capex, and a large part of it is because of onshoring of industrial supply chains. And we think that these 3 other factors, other than AI, are structural in nature and will continue. And then the second connected point to that is that AI capex is a relatively smaller share in total capex in Asia compared to what you see it in the US, because the other factors that I mentioned are quite important in Asia. So just to give you an example, and I have mentioned it on this forum before, that total capex in AI is $130 billion. Semiconductor companies' capex is $250 billion. This is all in 2026. But energy capex alone is $900 billion. So it's a different sort of importance in terms of Asia's growth story, the AI story, compared to what you see in the US. So that's on the first risk factor. The second one is oil. On oil, we have a simple framework that if oil prices are averaging around 100, then we should be okay. It shouldn't make us change our growth numbers. But if oil prices go to $120 and stay there sustainably, that would be creating some damage to regions' growth outlook. Now, to the extent to which we are not there yet in terms of staying in at 100 for a durable period, we still see at this point of time no change in our forecasts. The third risk factor is El Nino, and my colleague Jonathan Chung put out a detailed report on this. But so here, what we are again, simple framework is that El Nino is going to be strong, but the dynamics on the importance of weather for regions' growth and inflation outlook has reduced over a number of years because of reducing share of agriculture in GDP and also reducing share of food in CPI weights. And at this particular time, region also has higher proportion of reserves for the crops which are probably going to be at risk, particularly, which is rice. The inventory levels are way higher than what it tends to be usually at this point of time. And so in short, we think that this is an important risk to watch, but we also think that at this point of time in cycle, as well as the way the share and importance of agriculture is over a period, it's not a material risk. And then comes to the most debated topic for 2025, which is tariff. It's come back again. But as you can see from this chart, weighted average tariff is going up only by 0.9% now with this new tariffs announced versus where we were before those tariffs getting announced. So that's really not a material change in the tariff levels for us to be worried about. And finally, the story on rates, which is something that we just went overnight with the Fed. So on this issue, what we're saying is if oil prices go to $100 and stay there, and the Fed hikes twice, as what markets were pricing in, they're still pricing in that kind of path for the Fed, then we will have a few of the central banks like RBI, RBA, BI, and BSP tighten more than our base case. And some of the central banks like BOJ, BOK, and CBC will hike earlier than also will hike earlier. They will not in total hike more, but they will just move their rate hikes forward than what we have in our base case right now. So that's what we see. It will be a modest additional tightening effectively compared to our base case. And therefore, it will also turn out to be a modest downside risk to regions' growth rate. And finally, just to summarize, in all, I would say that AI CapEx is the most important one to watch. The other risk factors are either negligible or manageable. The question then is that how would you think about the growth downside risk? So we would say that if all of these factors come together, there will be a meaningful downside to regions' growth. But even in that scenario, we would call it as a mid-cycle slowdown and not an end-of-business cycle for two reasons. Number one is a lot of the CapEx drivers, which is at the heart of regions' growth story right now, are structural in nature. They're not cyclical to be rolling over with one or two of these risks materializing. And number two is that the corporate balance sheets are in a great shape. So in the past, when you go back into previous business cycles, you always invariably need either household or corporate or both of the balance sheets being in a state of over leverage condition. That is when you get a growth shock for exogenous factors or because the central banks are tightening, you will get an end of business cycle. But what is different is in this cycle that both corporate and private household balance sheets are in a great shape. But particularly corporate balance sheets are what we are watching more closely because this is a capex driven cycle. And corporate sector debt to GDP is lower than where we were pre-COVID, not only in Asia, but also in US and Europe. So with that, let me stop here and hand it back to you, Crystal.
Thank you very much, Chetan. And next we have Laura on the line, and who recently shifted the preference to H-share from A-share. Can you share the drivers behind also your outlook for Southbound inclusion?
Yeah, absolutely. So thanks very much, Crystal, for this opportunity. Since July, we've been advising investors to move your core positions within your China allocation from the Asia market to the Hong Kong market. This has been a quite major switch of our call because over the last 1 year or so, since June 2025, we've always been telling investors to put more of your money in the Asia market. And I think the Asia market had indeed outperformed Hong Kong quite significantly. But yes, starting from July, we think we thought that the Hong Kong would actually start to outperform. And so far, since July, Hang Seng Index had outperformed the MSCI EM index by over 15 percentage point, and even MSCI China, which is a combination of the entire offshore and onshore Asia market listed Chinese companies, had also outperformed MSCI EM index by more than 10 percentage points. So I think directionally our call has worked out pretty well. What are the drivers behind and how sustainable is this recovery rally of Hong Kong? We actually have been advocating for a allocation switch to Hong Kong around July time since May this year when we published the media outlook. Back then we said don't go to Hong Kong for now, but watch out for a nice window for a better setup for the Hong Kong market around July and August. 3 reasons for this call. One is that the second quarter earnings results season, which is exactly what we're going through at the moment, we always believe that the second quarter results season would turn out to be a much better one versus the previous quarters. MSCI China actually had gone through quarters after quarters of disappointment since mid-2021. And for this quarter, second quarter of 2026, we still expect it to be below expectation. But what we strongly also believe is that the magnitude of disappointment will actually meaningfully decline as a result of a calming down of the price war within the e-commerce sector. Why is that? Because starting from mid-April this year, the policymakers, the regulators in China had really cracked down on the price competition within the e-commerce players. And those were referring to the efforts put out by these players in terms of giving out free meals, free milk teas, etc., to try to gain the market share. And since mid-April, you could literally sense how that sort of competition has really calmed down quite significantly. And as a result, the damage on the earnings for these e-commerce players had also calmed down. So investors always care a lot about fundamentals, and this fundamental improvement, which is showing up on the earnings front, we feel would be a good catalyst for investors to feel much better about the Hong Kong market, which has e-commerce and internet as the biggest sector within the Hong Kong market. And the second reason is regarding the AI development. If we recall what had triggered Hong Kong to underperform so much, I think it's lack of exposure to the AI infrastructure components, such as the semis, the chip makers, and all these optical transceivers, etc. Of course, was a big reason to cause it to underperform Taiwan, Korea, and Japan. But another very important reason is because the hyperscalers, these internet large cap companies listed in Hong Kong, they were disrupted by ByteDance because their large language models, their AI functions, and the progress they made on these fronts were lagging behind, despite the major capex commitment they have made since the beginning of this year. But we had always believed that coming into the second half of this year, we would be welcoming a very intense period of these hyperscalers starting to communicate with the market, launching their new versions of the large language models, announcing the new AI functions they put into their ecosystem, which has exactly been what's happening since July this year. We had already witnessed the launch of Hunyuan from Tencent and the beta launch of the new Q1 model from Baba. And then there are also newer models from Zhipu, and then more models coming on their way in the coming weeks and months. So we feel with the performance demonstration being quite positive and the market feedback being quite positive, this is a reassurance of the capex money well spent. I think investors will feel a lot more relieved about how these hyperscaler companies and large language model companies are spending their money and are making decent, steady progress along the AI front. And the third reason is that we already sensed quite significant selling pressure coming from the IPO share unlocking. July and September actually would be two very heavy months in terms of the total amount of shares unlocked. As we start to digest these unlocking sort of selling pressure, not from July, but actually that selling pressure had been building up since May as we got closer to the unlocking dates. Investors who got into these positions early on would try to take profit, and even those who still have the locked up shares would still try to use structured products, etc., to lock in their better returns. So the selling pressure had been accumulating in the market since May, as far as we could tell. As the selling pressure had been gradually digested, now that we are actually already have gone through most of July, we feel the liquidity situation is actually stabilizing a lot better versus the previous months, etc. So all these three reasons had made us strongly believe that July going into August would be a very good window for Hong Kong to recover and rebound. And as you can tell, all these three reasons are intrinsic changes within the Hong Kong market. This has nothing to do with what's happening globally, with what's happening in the EM market in Korea or Taiwan or Japan. All of these three progresses and improvements are entirely just happening within the Hong Kong market dynamics. And this is why we feel quite confident about the resilience and the sustainability of this opportunity window. And looking forward, we think between July and all the way through September, things should look quite decent. This is because we still have more earnings results coming up, and investors should gradually feel more comfortable with the fundamentals recovery. And also, I think my colleagues' comments earlier from Chaitan, from June, etc., we understand that there are still uncertainties that's being sorted out on a global basis. So Hong Kong being quite independent from the rest of the world, particularly in this cycle, I think the uncertainty, somewhat sort of the persistency of the uncertainty in other markets could help Hong Kong to stand out as a great destination for diversification purpose. But as we go through these uncertainties, as things start to probably settle more, if the Hormuz situation can calm down, if the Fed policy can show more clarity, and the oil price can stabilize and potentially even drop, and as the over leverage and the panic sentiment in the AI trade gets fully digested, I think investors will start to look for even more catalysts to stay positive with the Hong Kong equities. At that point, we will need to look into the third quarter results season and then into the year end. It would be great if we would have more positive earnings outlook guidance from all these companies as they publish their second quarter results. We will closely monitor those as a gauge to the sustainability of the Hong Kong rally into the fourth quarter. We think the third quarter is largely intact. And this preference between Hong Kong and A-shares, for the time being, we definitely prefer Hong Kong. But to my earlier point, in terms of global stabilization and more catalysts to sustain Hong Kong's rally, one thing we notice is that for this particular cycle, actually A-shares have shown higher correlation with the global market because of this much higher composition in the hardcore technology and in the AI exposure within the A-share market. So if the external global market starts to stabilize, we think that would also help the A-share market stabilize as well. So depending on the earnings, the fundamental catalyst for Hong Kong, whether those will continuously show up, we would reassess the situation as we get closer towards the end of the summer and going into the fourth quarter. That's it from our side. Thanks very much, Crystal.
Thank you very much, Laura. And then next we have Shou to share his views on Japan. And Japan this month actually has been holding up relatively well. Can you share your views on where Japan is sitting and then how to allocate within Japan?
Of course, thank you, Crystal. Recently, Japanese equities seem to be reacting more to positioning than to fundamentals. Share price moves have been quite violent, and this week, even bank stocks, which had been relatively firm, were sold. It looks as if investors are crossing long positions across the market. The thing felt close to capitulation. And I'd describe the current market as a combination of three things happening at the same time. Number one, AI remains a strong structural investment theme. Number two, earnings expectations for AI corporates have been very high. Third, investor positioning is still clouded, especially on AI. And when these three conditions come together, the market becomes very difficult. Good news may not lift the share price, while even small disappointment can cause a sharp decline. For this quarter earnings season, we recently published a strategy report titled AI Revive Value Alive. Our main scenario is that capital returns to AI-related stocks, while cyclical value stocks that have lagged behind also catch up. The biggest factor for this scenario is the capital spending plans that US hyperscalers will announce this week. Our US internet team has one of the more bullish views on hyperscaler capital spending on the street. If the hyperscalers maintain or raise their capital spending plans in this week's results, concerns that the AI investment cycle is peaking may ease. That should make it easier for capital to return to AI-related and momentum stocks, at least initially. But as capital spending grows, the credit market also becomes more important, as we can see credit spread widening. In this regard, our US credit strategy team expects financing to shift over time. The focus may move away from data center shells and toward chips, computing equipment, and energy infrastructure, including gas turbines. And chips and compute equipment account for roughly 60% of total data center costs. If more financing moves into these areas, it should support expectations for earnings growth among corporates further upstream in the AI value chain. This US capital spending cycle is one reason investors remain positive on Japanese AI-related stocks. But the thing is, earnings expectations for Japanese AI stocks are already very high. If in the current market, simply reporting results in line with analyst consensus is not enough. Even beating consensus may not be enough. The number that matters for the share price is the buy-side expectation, which should be above analyst consensus. For that reason, the risk-reward in AI-related stocks is less attractive than it was before. We need to be careful with cases such as Yaskawa, Disco, and Sheets Chemical. If results are only in line or fail to meet the market high expectations, the share price can fall sharply. This brings us to the cyclical value stocks. These corporates benefit from AI investment, but their share prices have lagged. One representative example is Core. Core's results showed solid demand for AI servers. They also showed early signs of recovery in demand from industrial equipment after a long period of inventory adjustment. This is an important change because it may mean that the benefit of AI capital spending are starting to spread beyond the main semiconductor equipment and data center names. The benefits may now be reacting electronic components, industrial equipment, and other surrounding areas. So compared with cyclical growth corporates, market expectations for cyclical value corporates still appear relatively low. And when expectations are lower, the downside risk around earnings announcement is also lower. If earnings recover more strongly than expected, the positive surprise is more likely to be reflected in the share price. As the AI investment cycle is reassessed, capital can return to the core AI names, of course. At the same time, the benefits of the spending can spread to surrounding industries, allowing lagging cyclical value stocks to catch up. This is what we mean by AI revive, value alive. And the one last thing I'd like to discuss is cybersecurity. Many investors the emergence of the Chinese open source AI model, Kimi K3, as a threat to the earnings opportunities of the US frontier AI corporates. If the US government tightens regulation because of security concerns about Chinese models, corporates will need to monitor the AI models they use, prevent data leakage, control access, and protect the whole supply chain. In simple terms, the more AI models there are, the more corporates use AI, the greater the demand for cybersecurity will become. And actually, within the basket of the strategic sectors identified by the Takaichi administration, cybersecurity basket had underperformed because investors were worried about AI disruption. But recently, there have been signals that performance may be bottoming. And rather than seeing Kimi simply as a rise of Chinese AI, it is more useful to see it as a trigger for a rapid increase in the number of corporates using AI. From that perspective, the investment focus can broaden from corporates that build AI to corporates that help others use AI safely. In that sense, cybersecurity could become one of the main beneficiaries of that shift. I'll stop there and hand it back to Krista. Thank you.
Thank you very much, Joe. And last but not least, Daniel, let me hand over to you to talk about the note that you collaborated with Stephen Burke on AI infrastructure dip, and then what are the analysts are expecting from June quarter earnings in Asia and EM. Over to you.
Okay, thank you, Crystal. So let me just try and share the note and talk through this. We really addressed with the Global Collaborative note published on Monday where we're seeing the overall cycle and these debates around the pullback in the AI infrastructure stocks. What's real? What are we actually concerned about? And what do we think is overblown? Key message for us is we think the CapEx outlook is very strong into 2027 and 28. And the key reason for this is we're still seeing the economics of AI infrastructure build out being highly accretive. Brian Novak on our US internet team working through the economics, the factory economics of token generation is seeing ROIs of 25% up to 40% for various business models around AI cloud infrastructure. It's going to be a little bit lower than that if you're running an LLM and needing to rent that capacity. But if you're vertically integrated, particularly for the hyperscalers, they're seeing very strong conviction around the returns that are going to accrue from this capex deployment in the coming years. So we also look at concerns around financing. The show's done a good job of summarising some of the key views here from our credit strategy team across both public credit and private markets, seeing that the ecosystem is evolving to support this issuance. We're seeing both the free cash flow generative businesses in semis wanting to provide that support, but at the same time we're also seeing an adjustment in the credit markets around this much more significant role for issuers in the tech space. So pushing out credit spreads as we expected, but ultimately with a lot more capacity still to come. And then in terms of the other fundamental concerns, I think two or three to mention here. Chinese open weight LLMs, what does that mean? Ultimately, we think this is going to reinforce that Jevons paradox that Nakazawa-san has referred to, that it drives more penetration into the corporate sector, faster adoption, and that ultimately is then feeding back into more infrastructure demand. The models that are coming through are still showing for significant and more complex use cases, still showing a lot of compute intensity being required. We can also see the competitive dynamics that are resulting from this Chinese open weight model development and the competitive intensity of the Chinese ecosystem. We think that's also pushing this geopolitical driver of the US ecosystem and Chinese ecosystem competing for world leadership. And we saw the address at the World AI Conference and the World AI Conference organization standing up a number of members to continue to look to support that ecosystem. And so if we're thinking about the implications of this dynamic, clearly one of the risks would be actions that look to drive a decoupling. But we still have a very deep interdependence between the US and Chinese ecosystems that are important. So if the economics are still there, then really how we react into this market, we think this has been very much an unwind of the crowding, very high expectations that are built up in the AI supply chain, and unfortunately these charts are not loading. So I'm going to switch to a PDF of the notes. Give me 1 second. So in terms of the crowding, Crystal, your work on flows and positioning signals, this is back in July 2nd. We're showing red flags for Taiwan, for Korea in particular. We've been talking about the very narrow market, and as of 22nd of June, we published on this and pointed out that outside of the second half of 1999, we'd never seen a market so narrow. And since then, that really marked the peak of the tech sector in particular and broader markets. So compared with the 22% of stocks that have been outperforming the index to the 22nd of June year to date, we've now seen 73% of stocks outperforming the index since 22nd of June. So it's the silver lining of what we're seeing here is a very rapid broadening of leadership in the market. We're seeing areas that have been left behind unfairly, and we've heard from some of our colleagues about areas that would flag. But now we're getting valuations in tech that maybe better reflect this parts of tech anyway that better reflect this opportunity set. So I'll pick up on a couple of charts here. So for semis overall and tech hardware, for tech hardware we've got the sector trading on PEs. This was as of 24th of July at 7 times. Actually, that's coming down now to around 6 times. If we look at the Korea market, trading 5 times, that was as of 24th of July. This is now trading closer to 4.5 times for MSCI Korea. So the valuation has been pretty quick, but to the point that Show was making, expectations on earnings had also moved very, very high. So where do we go from here? In conclusion, we said in the note that we think the risk reward on the AI infrastructure is much better positioned and clients should selectively re-engage. We've looked to screen a selection of companies that we think are in that position of having been either oversold or still having very compelling outlooks. And so we pulled them into this list here. 29 stocks of preferred APAC plays on a recovery in AI infrastructure sentiment. So do take a look through these. Some of them are performing quite well since amid the volatility. And we would also reinforce this call that we're making to look to broaden out. It's a call we've been making really increasingly through the second quarter, and with the broadening out, does include other beneficiaries of the industrial super cycle that Chetan and the team have been mapping out for us. So that includes energy security, powering some of the renewable energy, the energy storage beneficiaries, stocks like CATL that have been somewhat left behind in this crowding, as well as looking for other areas. And Show's comments on cybersecurity are really interesting. We also think the China tech space, as we look at names like Baba and Tencent that are positioned as infrastructure providers in cloud, have also been left behind and are offering very compelling valuations, as we see in the mapping of growth and valuations by theme. The left-hand axis, or the x-axis here, China's AI path. You can see, for example, stocks here, including the Chinese hyperscalers, offering north of 20% growth for under 20 times earnings. They are an outlier in terms of the GARP proposition in front of us. So covered a lot of ground. Let me pass back to you, Crystal, for any investor questions.
Thank you very much, Daniel. And then now we are moving on to the Q&A session. There's one question more for Chetan for today, which is on Strait of Hormuz, which we haven't been talking about for quite a while. And then actually just a couple of months ago, and there was a lot of fear about the supply chain. And then there was a hard deadline of the strait being completely open by end of June. So, but then recently we haven't really been hearing those fears, especially for India or Asia. And then can you share any updates? And then as people haven't really been talking about it intensively.
Yeah, sure, Crystal. So look, I think the way we were parsing that issue was in two ways. First part was about the supply shortages, and the second was about the prices that you pay. Now, as far as the supply shortage is concerned, the region seems to have worked it out. And we are now not concerned about supply shortages having an impact on the domestic production. So, for example, India was facing constraints on gas supply, and also some of the other countries in the region. And what they seem to have now done is got that supply from alternative places, particularly the US. And that has kept that situation as far as the critical gas supply, which is needed, because some of the businesses cannot operate without gas. They cannot be using substitute sources of energy domestically. So for that, you do need imported gas, and they have managed to source it from the US. Similarly, on fertilizers, everybody had a lot of inventory. But then in this period of disturbance over period, because in the short period, like 3-4 weeks, they cannot source it from anywhere. But if you give some time, which is what has happened by this time, they've been able to source it from other places like Russia and Egypt and other economies which have the ability to produce more, to ensure that you don't have like a complete shortage situation. And so now what we are left with is prices. And as far as prices are concerned, crude oil, we can see on the screens, it's not that high, but refined products are high. But on that, again, a whole lot of economies in the region. So India, China, Korea, Thailand, they all have, Japan also have domestic adequate refining capacity. So they are able to manage to control the refined product prices because they have a huge amount of capacity onshore and they're not dependent on imports. But economies like Australia, they would be suffering more because they don't have the domestic refining capacity. But if you think about it as a region in aggregate, supply shortages are not an issue. Price is an issue, and price also is more relevant. Price is crude, not necessarily the refined products. So with that, I'll give it back to you, Crystal.
Thanks very much, Chetan. And we also have another 2 questions for Show on Japan. So can you share some of your initial thoughts on the implications on the Kumamoto earthquake for Japanese equities? And then also, how do you see the Japan BOJ meeting playing out? And then what are the key market implications?
Sure. Thank you, Crystal. Regarding the earthquake, in my base case, major factories and logistics networks recover gradually over about 2 to 7 days. The first round impact on aggregate topics earnings should therefore be limited. The semiconductor factories cannot restart simply after checking the safety of the buildings and production equipment. They may need to discard work in progress inventory, recalibrate production equipment, and requalify clean rooms and secure ultra pure water and a stable power supply as well. For this reason, a return to normal production may take time even after operations restart. The sectors most likely to face a relatively large short-term earnings impact are electrical equipment, transportation equipment, pulp and paper, and land transportation, details, and insurance as well. The risk scenario is that after shocks or disruptions to industrial or water power loads and ports continue for 2 to 4 weeks going ahead, in that case, the impact could spread from semiconductors and electric components to autos and industrial machinery, and then to materials industries such as chemicals and non-metals as well. When judging whether a factory has normalized, we should not look only at whether the company says operations have restarted. We also need to ask what percentage of the pre-earthquake capacity has returned, whether yields have normalized, and whether logistics, water, and power are stable. And regarding this week's BOJ meeting, we think the most likely outcome is a hawkish hold, as OIS market has barely priced in July rate hike right now. The market is pricing about a 20% chance of a September hike and a little over 80% chance of the October rate hike. The basic idea is that the BOJ may push the market to price October hike more firmly without sending a message that materially raises overall terminal rate. The BOJ will probably want to avoid being seen as a trigger or the scapegoat for sharp market moves like the one in the summer of 2024. For that reason, it may be difficult for the BOJ to send an excessively hawkish message. On the other hand, with the yen still weak, it is also difficult to emphasize only a very gradual pace, no one hike every 6 months. The BOJ could therefore be hawkish enough to make the market price October hike more firmly. In that case, the BOJ event would be neither clearly positive nor clearly negative for bank sectors. On its own, we would view it as broadly neutral right now.
Thanks very much, Shou. In the interest of time, we'll wrap up today's session here and answer remaining questions offline. Thanks so much for joining, and do reach out to me and the team if you have any other questions. Have a nice day and see you next week.